So, Chapter 8, Interest Rates and Bond Valuation. So hopefully this chapter is just a review for you. There shouldn't be a whole lot of new information introduced in this chapter, but it doesn't mean it's not important. So, key concepts and skills, important features of bonds and bond types, understand bond values, why they fluctuate, how they fluctuate, understand bond ratings and what they mean, understand the impact of inflation on interest rates, understand the term structure of interest rates and the determinants of bond yields. So, chapter bond valuation, government and corporate bonds, bond markets, inflation and interest rates, and determinants of bond yields. So, bonds and bond valuation. What is a bond? A bond is a legally binding agreement between a borrower and a lender that specifies the par or face value. It can also be referred to as the maturity value, coupon rate. That is the fixed rate on the bond. Coupon payment is based on the face value and the coupon rate. Note most bonds pay interest semi-annually. Maturity date is when that principal is also, or another word for the par or face value. That principal is returned to the to the person that bought it or that owns the bond, not the. So, yield to maturity bond is the required market interest rate on the bond. That is the value that is the rate that is used to calculate the price of the bond. So we're going to do calculations. And you can use the time value of money functions on your calculator. There's also a bond function on your calculator as well. That is if you hit second and 9, that would get you to the bond function. And we'll also do, we can calculate price and yield using Excel functions as well. Bond valuation. The primary principle of the value of any security is the present value of the expected future cash flows. Bond value then is determined by the present value of all the future coupon payments plus the return on the par value. Remember, par, maturity value, principal, all face value all refer to the same thing. So interest rates or yield are inversely related to present values. So the higher the yield, the lower the price. So the formula for pricing a bond is bond value is equal to the coupon payment plus 1 minus 1 divided by 1 plus R to the T power. If we're most cases, we're going to be dividing this by 2, and we'll be multiplying T by 2 because the vast majority of bonds do pay interest semi-annually, and then we divide that by R. And then we calculate that's the present value of the annuity, that is the coupon payments. Then we take the present value of the face value. Again, we divide that by 1 plus R, again, and to the T power. T and N are interchangeable. So that gives us the present value of the coupons and the present value of the face amount, and we add those together and we get the price of the bond. So, example here, the U.S. government bond with a 6 3/8 coupon. 3/8 is 0.375, so that's 6.375%. That, I don't like the word expires. It actually matures. That would be the appropriate word here. The par value of the bond is $1,000. Coupon payments are made semi-annually. June 30th and December 31st for this bond. They occur 6 months, exactly 6 months apart. So since the coupon rate is 6.6 3/8%, the coupon payment, the semi-annual coupon payment is 1,000 times 0.06375 divided by 2, which would give you $31.87.5. On January 1, 2019, the size and timing of the cash flows are as follows. We've got $31.87.5 every 6 months, beginning 6 months from today. And they'll go all the way out to maturity at 12/31/23. So we continue with our example. So on January 1, 2019, the required yield, our yield to maturity, is 5%. So the current value is going to be our coupon payment divided by the coupon rate divided by 2. And we multiply that by 1 minus 1 divided by 1 plus 0.025. That's 0.05 divided by 2. And our N or T is 5 times 2. That's 10. And then we divide our maturity or face or principal or par, whatever you want to call it, by 1.025. Again, that's 1 plus 0.05 divided by 2 to the 10th power, and we get a value of $1,060.17. We can also do this calculation on our calculator. So our N is 10, our IY is the 5 divided by 2. Note you enter that as a whole percent, or 2.5. So our payment is our coupon payment, so $31.87.5, and the future value is the face value of that bond. And we compute PV to get our $1,060.17. The negative is based on the logic of the calculator. So, but remember that you always need to use the rate per period to do this calculation, and you need to modify the years, multiply them by 2. So you take your yield to maturity, you divide it by 2, and you take your years and you multiply them by 2. So we will do another example in the beginning of the next lecture.